Now it's time to have a look at what your realistic return expectations can be if you start building your dividend portfolio. I've already shown you this calculator, which helps you figure out one part of the equation, namely the dividend component of your total return. Based on the current market conditions, you can achieve a yield on cost or yield on investment of about 10% within 10 years if you reinvest all your dividends in this initial period. More about the possible phases of portfolio building later. This 10% yield on cost means that you get back 10% of your original investment in the form of dividends in the 10th year, and these dividends are supposed to grow further. This 10% can be achieved in various ways with different starting yield and growth combinations, as you already know. The blue line on this chart shows my AT&T stock position, which I bought with a starting yield of 5.75%, and I calculated with a dividend growth rate of 2%, which has turned out to be correct so far. The orange line illustrates how I expect Archer Daniels Midland to perform. Considering its strong dividend coverage and the dividend growth rate numbers well above 10%, it should be able to provide a yield on cost of about 10% in the 10th year. Before we move on, don't forget two things. Dividend growth investing is not about waiting 10 boring years and reinvesting all your dividends to get to the annual 10% yield level. During this period, the stock price should have moved up along with the dividends, and your annual total return should be the sum of the current yield and the dividend growth rate if you observe the rules. And this is no surprise by now. With such investments, you can comfortably beat the market, as you'll see in a minute. And the second thing to keep in mind before you compare the return potential of dividend investing to any other alternative is the freedom dividend growth investing gives you. You don't need to stare at the screen all day long following price movements, so you will not have such psychological problems that active traders have to deal with. You can live your life while earning a good return and getting predictable and growing passive income. This factor is hard, if not totally impossible, to quantify, but it shouldn't be left out of consideration. I highly recommend that you read this article about achieving the 10% yield on cost level, and now I want to show you some real examples, because playing with a calculator is easy, but I am ready to come up with some really convincing data. I created this at fastgraphs.com. You can check out their free trial if you wish. You can see that if you had invested in Philip Morris stocks in 2008 with a starting yield of 3.1%, which you can find in the last column, your yield on cost would have grown to 11.1% by now. So the previous theoretical calculations are not far from reality at all. And please notice that your annualized return would have been above 13%, while the S&P 500 index provided a return below 8% in the same period. Both are calculated with the reinvestment of dividends. A really nice yield on cost and a market-beating total return, exactly what I love. Here is AT&T with a different profile. This stock offers a higher starting yield and a lower dividend growth rate, but examining a 10-year long investment time frame, the yield on cost climbed to nearly 13%. And we see a market-beating annual total return as well, while AT&T is certainly not the stock that gives too much excitement to its owners. It just sends the money. And McDonald's provides the third example, simply crushing the market with its 17% annual return. This was a typical low yielder with high growth, the evidence of which you can see in the last column. The return and yield on cost numbers are much more tasty than their burgers. After the 10-year-long investment periods of the previous examples, let's spend some more time with one of the dividend champions, Johnson & Johnson. I took this example from Josh Peters' book, The Ultimate Dividend Playbook, and I want to use this to show you how to discover the background, the underlying factors of outstanding performance. Let's assume you bought 100 shares of Johnson & Johnson for $6,500 on the 4th of May in 1977. I wasn't even born then, by the way. You simply held the stocks, collected and spent all the dividends for 30 years, and sold the shares on the 20th of May in 2007. Let me mention that there were some stock splits during your holding period, so you had exactly 4,800 shares of Johnson & Johnson at the time of the sale. As the stock splits distort prices and dividend data, you can use the calculator on Johnson & Johnson's site to check this example or customize the calculation if you wish. Here is the link. The chart shows that this investment was really good. You could sell your shares for nearly $305,000 and you have collected nearly $57,000 of dividends. Compare these with the capital of $6,500 you invested. Let's see why things worked out so well for you. This will highlight how the theory you've learned works in practice. Johnson & Johnson's dividends grew at an annual average rate of 14.4%, which is quite spectacular. This means that the original $140 annual dividend climbed up to nearly $8,000, which is more than a 50-fold increase. The total dividends you received amount to about 9 times your original investment. The stock price increased at an annual average rate of 13.7% for 30 years. And this is very close to the rate of the dividend growth. By now, you must know that it is not a pure coincidence. Wherever earnings and dividends go, price is sure to follow. This is what happened. I hope the returns you've seen so far are more than satisfactory. And now I'd like to give you a tool with which you can carry out your calculations and produce additional proof if you wish. Just follow the link below and you will find the dividend reinvestment calculator and an S&P 500 return calculator. I used them to compile this table. As you can see, the market could be beaten in the last 10 years by investing in quality dividend stocks, and I hadn't even handpicked the best of them here, since my sole purpose was to illustrate that there are several potential candidates offering similar returns to Johnson & Johnson or even better. As most professional money managers underperform the market, they would kill for an annual outperformance of even 2 or 3 percentage points. It is absolutely available for you. And to prove that I have really not cherry-picked the best dividend stocks with the benefit of hindsight, here is Chevron, the oil giant, the stock of which gets slaughtered because of the free-falling oil prices. If you had bought 100 shares on the 5th of January in 2005 for the price of $50.88, held the shares and spent all the dividends, then sold out in August 2015, then the total dividends you received would have been $3,090. Your original investment of $5,088 would have grown to nearly $12,000, adding up the dividends and capital gains. And this gives you an annual return of 8% without dividend reinvestment, while the S&P 500 index returned 5.4% in the same period without dividend reinvestments. Another market-beating performance, even in this nightmare scenario. Now look at that stock price chart, the steep fall, and then look at the annual return figure and draw the conclusion. Invest in quality dividend payers when their stocks are attractively priced and hold them for the long run. If on the top of this you diversify as well, you'll be unstoppable. Here's a really thought-provoking comparison I found in a Seeking Alpha article, the link of which you can see below. I've quoted Buffett many times so far, and now you can see how his investors, the shareholders of Berkshire, fared compared to the owners of some quality dividend stocks in the 10-year period examined. As Buffett's company pays no dividend, you should compare the figures of the third column, as this assumes that investors didn't get dividends from the other companies either, but this money got reinvested, just like in Berkshire's case. I don't want to come up with serious conclusions. Suffice it to say that picking quality dividend payers and dividend raisers wisely can provide the return which is very competitive. If you need more proof, I encourage you to use the tools at your disposal. After all the quality dividend payers have publicly available data, so you can do as many calculations as you wish. Two things to keep in mind, however. Dividend growth investing is a long-term approach, so the minimum time frame of your calculations should be 10 years. And don't forget what Howard Marks, a super investor, said. Any top quality stock can be a bad investment if bought at too high a price. I hope you remember the Walmart example. So avoid basing your calculations on overvalued purchases, as the system you've just learned will keep you away from such transactions. While crunching the numbers, keep in mind the unquantifiable advantages of dividend investing as well, namely that you can have a life. Dividend and price appreciation are both important as they make up your total return, but the freedom you can have with a quality dividend portfolio is what really determines the quality of your life, not some fractions of annual return percentages.